regulatory panel. Unfortunately, one regulator from Congo couldn't make it in the recent time, but Ram, Lazarus, myself, and obviously more importantly, we have you. So that's where the questions will be. So the first question we have is, what are the primary operational challenges in terms of regulatory adherence and compliance? You want to start off? And then we'll take questions from the crowd and take a little bit.
Thanks, Faisal. I think from our experience, the first challenge is just having the regulatory framework in place before you can.
So there's a very famous saying that, there's strangulation by regulation. Do you agree to it?
I agree 100%. But I think we've it's a paradox really in this space in the remittances where we're sitting in between, that's what we're remittances, sitting in between traditional banking and telco-based wallets. So the question of who actually regulates the space is a challenge in most of the markets. In most African markets, the challenge of actually the regulation of the e-wallet is still a big issue. Some of the countries don't have any clear regulations around that. Neither do we have a department that deals with that. So you have a working group between the telco operator and the banking regulator. It's a little bit unclear.
But there's also a tussle between the two. So sometimes the telco regulator says it's my concern. Sometimes the banking regulator says no, money is under my domain.
That's good. But in both instances, whether there's over-regulation or where there's little or no regulation at all, it creates uncertainty and also an environment which is difficult for players to invest in, and therefore you have this unusually high cost of doing business currently because there's a minimal number of players in this space. So clearly, for me, the biggest issue is regulatory certainty, and also light touch regulation, which is concomitant or directly proportional to the risk posed by a $100 transfer or $50 transfer. So it's no point having some really heavy regulation, which has to do with moving $15,000, $100,000. Then we're talking about terrorism financing, must be controlled and so on. But if all one can save is $50 or $100, surely there must be a lighter touch. So if you ask me, is regulation a problem? Yes, it's a challenge currently.
One area that comes up more and more in regulation is a very black and white law. And unlike fuzzy logic, which is a percentage-based law, there isn't any ramp-up period in between. It's either yes or no. Transactions, on the other hand, are layered. So you can have small transactions which require minimum amount of information from KYC and compliance, and medium tiers, tier 1, 2, 3, 4, and you can define them the way they are. But regulation doesn't take that into consideration. Why is that so?
Well, I think regulation has not evolved in the same manner as technology has over time. One must understand that banking traditionally deals with the risk. The regulators here will probably agree with me, not the opportunity. They want to reduce the risk related to specific types of transactions. So it's more of a traditional thing than
that's a deposit and a loan-based risk. I've never heard a bank go bankrupt because they were processing remittances.
That's true.
In fact, the only banks that were processing remittances and did get chastised was because there was willful default by the bank not to follow regulations. HSBC, Barclays, Deutsche Bank, and many other examples.
I think it's a valid point. Look, there will always be a lag between technology and entrepreneurs and what's happening out in the market and what the regulators come up with. The real trick is, in my opinion, is what happened in the DRC and in Zambia 10, 15, 20 years ago when mobile payments started, where they issued letters of no objection, and then they watched the industry grow, and then they regulated after that when they actually understood what was happening. That for me is probably a way that regulators can address this instead of jumping in, taking existing rules and saying, right, this is what it is. Because when you do that, you probably stifle the whole ecosystem.
Well, I can speak on that because a lot of regulators are actually literally Xeroxing bits and pieces of regulation from, let's say, the UK or the European Union, from the payment directive, or from the money transmission laws in the US, which there are 50 of them. And then they find out it's a hodgepodge porridge that just doesn't make sense.
Yeah, that's true. Look, there are some good examples. In Zambia in 2007, they implemented the National Payment Systems Act. And I think it was a good piece of legislation that was locally driven. Yes, there was some lessons from the EU's e-money sort of regulations or directives, but it was primarily a home-driven piece of regulation. And if all developing nations follow that sort of approach, you're not going to have a hodgepodge, inappropriate set of laws in your entity. I mean, KYC is a big example, right? I mean, we have restrictive KYC regulations in most African countries, which are based on European standards. So you must have a bill that's in your name, and you must have, maybe you must prove your income, where it comes from, etc.
Worldwide, I don't know if everyone has a smartphone. And I think one of the biggest challenges is contact management. Pretty much everyone is either using LinkedIn. No one saves their numbers on a SIM anymore, because it's either using LinkedIn or using a Facebook or maybe a couple of other apps to save your number. There is no worldwide common denominator when it comes to KYC. The Europeans say, well, we need stranger KYC. We say, fine, we'll give you our fingerprints. Would you do the same? Absolutely not. So KYC, I think, is a challenge. Federated, consensus-based identity management just does not exist today. And that's a huge issue. And that's what we were talking with Samir, so here somewhere. And that's a huge issue and will remain so.
But this is the challenge now. I mean, we've got regulators in the room, and they probably in their official capacities are still asking for this KYC. But I mean, it's not only difficult to get, but in most African countries it doesn't exist. So a guy lives in a shack or lives in an informal settlement. He's never going to be financially included because he will never have a water bill or a municipality bill. And that's really a challenge. In some countries there's no central ID system. So how do you prove who you are in that case? So yes, when regulations are set up and they are borrowed from Europe, America and so on, and then you implement them in Africa or in any developing nation, it can be a little bit inappropriate and stifles mobile remittances.
Very quickly, I want to ask you, Ram, how flexible as operators and OEMs of these complex softwares that you make are your systems when it comes to KYC? Because you're dealing with multiple territories, multiple requirements, and how do you gel it all together?
We knew that we would have this. I think it is.
Yeah, okay.
We knew that we would have this challenge. So when we set about designing our KYC systems, we took into place a model which we could customize for every country, the requirements that we have. Obviously, like Lazarus was saying, it differs from country to country. Some have national databases that you can look up, which makes it a lot easier. Others have none. And some have very restrictive requirements, like a bill, all those documents which our customers will never have. Right, and we are targeting a demographic that will not have these items. It's a challenge to work with regulators on this, because the other thing that I find dealing with regulators every week is that the people who are processing the approval applications and all that at the lower levels in the regulator, they don't have market exposure. They don't know what it is that you're trying to achieve. The regulator, the governors of the central banks, the heads of the departments, they know what they want to achieve with new technologies, with new developments coming in remittances, how to encourage remittances, target to the demographics that don't have ID and so on. But that those policy statements don't translate into direct action down the line. Down the line, you're still regulated on the bank paradigm of you are a white collar, you have a white collar job. You maybe own a house. You have an employer who can give you an ID. All those frameworks.
many here, show of hands, think we are over-regulated? There's one brave soul somewhere. Okay. And how many think that we are under-regulated? Oh, are you regulators? Regulators typically are like under-regulated. But I want to bring a really good example is, and you'll be hearing a lot of examples from me, that's what I do, right? But Singapore was a really interesting example. I walked into the Singapore MAS, the Monetary Authority of Singapore, and we had a client with me and they wanted to open up a remittance, an e-money thing. And we walked in and he said, Mr. Khan, you finish your coffee and you will not have time to finish your coffee and I'll have your license granted. And I was so blown away. I said, why? How come? He says, guess what? If your net outstanding every night is less than $15 million, you don't need a license in Singapore for operating an e-money service. How cool is that? Turkey has a license now. Anyone from Turkey is regulator? I haven't asked this person. Turkey has a $2 million price tag, if you will, on the license. Singapore is $0. Europe and Neopay is conducting a workshop right next to us, $5,000. The most coveted license in the world happens to be New York and California. $2,000 fee, $500,000 paid up capital versus $2 million over here. India is even, I think it's equally also $2 million or something like that. And so we have disparity. The more freer the market, less the price. The more restricted the market, higher the price. So, but anyways, I want to ask the question on costs of remit, of compliance. Do you, show of hands, very quickly, do you think cost of compliance has gone up or down?
Up.
Up? How many think up? And why is that so?
Because of security. Because of security.
Multi-channel.
I was talking to a gentleman in Citibank, blew me away. You know how many people Citibank has in compliance? 34,000. 34,000. And you know what the mandate given to the new CEO is? To take that number up to between 40 and 45,000 before June. And just think about that. 34,000 people in compliance. That's like a stadium, right? With just, hey, compliance match going on. But compliance is a huge issue. And I think there's also, it's very fair to say there's also a clash between finding that sweet spot. You know, no compliance, fully compliant, somewhere in between. And that's where the constant struggle is. What do you think on that? Specifically with respect to costs.
It's obviously we want lower compliance, lower costs. I was at a conference in Istanbul a few months ago, Hugo's IMTC, where one of the participants was saying, an MTO was there, and they said they spend 60% of their 60% of the costs are in compliance. It's an MTO. It's really, don't you think it's really over the top when you spend 60% of your costs on compliance?
Hey, you're asking for a person. I have a very skewed view on compliance.
So let's hear that.
No, I just feel that first of all, the fragmented markets, they are not getting together. The regulators are not getting together to literally balance themselves out. You have one that's asking so much. I'll give you a very classical example. In Pakistan, we have something called biometric. Everyone over the age of 18 gets biometrically verified. And it's not like you can just walk into a place and just get yourself gen printed and face and iris fingerprints, iris scan, sorry. You have to prove who you are, bring a lot of documentation before that process can happen. And by then, you get biometrically verified. To open a bank account, nowadays, you also get biometrically verified. To get a SIM, you have to get biometrically verified. There is no way in hell you can say, this person is not who he is. Put your thumb here, we know in 2 seconds. So we have something called a National Database Authority. When we're doing a remittance into Pakistan, and when you tell, they say, well, your KYC is not up to mark, you know. You biometrically verified you, what else do you want? Don't you accept that? No, we don't. That's a disconnect. You have a country where every person's, where money going into an account is biometrically verified, but yet we want bills. Millennials don't have residential, bills. They don't have telephone bills. They don't have, in fact, they won't even know how to use a landline, probably. So how do you get those bills? How do you get proof of employment? People who are freelancing, you ask a bank, well, do you know freelancers that he earns from Fiverr? They wouldn't know what a Fiverr is. They wouldn't know what Upwork is or Uphold or the other marketplaces online. And they're not willing to accept that. And that's where the disconnect lies. Your thoughts?
So just taking that whole KYC debate back to the issue of costs. Look, I think regulatory drip work, regulatory cost comes in two ways, right? So it's the initial application fees and stuff like that, and there's the ongoing regulatory licensing fees or levies that you pay day to day. All this translates into operational costs, higher operational costs for the players in the industry, and therefore higher costs for the customers, making this space unattractive, as it were. So the only way to bring on board new players is if the regulatory drip is reduced, which effectively then allows new players to come in because then it's profitable. When that happens, the pricing for using international remittances goes down. That works for everybody. So the question to regulators is, to what extent can they balance their requirement for information integrity, compliance, together with just having a model that actually works in practice. So South Africa is a good example. The regulatory regime is so restricted that M-Pesa has no work there. You have to go through
South Africa is the ultimate example of an authoritative state, where only 5 players over there, and if you can have coffee with them all you want, but you're not getting a license.
Exactly. So it's an extremely restrictive regulatory regime. And because of that, costs are high. And guess what? The incumbents are not willing to carry the heavy regulatory costs. So therefore, there's no meaningful remittances played in South Africa.
I also feel that this also goes to people like Terra and all that. You need to get more regulators on the plane and bring them up.
They don't get visas. Right?
That's another conference happening right next door. But getting those regulators, because they need to hear this. They really need to hear what the pain points are of the industry.
There is something else. We are paying for regulators' inefficiency. Mobile wallets in every country that we're talking about are licensed by the same regulator who licenses remittances. Right? But these same regulators tell us that the mobile wallet KYC is not sufficient. You need to do additional KYC. Now you have licensed these mobile wallet platforms. They are running here 15 million, 18 million, 20 million people in your country. And you're overseeing the compliance for those. But they are not satisfactory. Instead of making sure that that compliance is satisfactory, you are now creating regulatory hurdles to adding remittance services to it. So this is, I think, a bigger problem than what we are talking about. If the mobile wallet KYCs were sufficient, a lot of these issues that we are facing wouldn't arise.
I feel it's very important for the sending side country regulators to visit the receiving side country on-ground market and see how things work. I went to to the border of Kenya, which touches Somaliland and so forth. I saw how they're now using the vein biometric and how a person coming in for the very first time, Africa is a beautiful culture because they can recite their ancestors literally 20 generations back and prove who they are. And that's what the software actually takes into account. I'm not joking here. This is not a joke. They literally have to give their information and recite their maternal and paternal generations back, and they have this database of knowing how the names, because the names are very wrong. And that's how they register them, and they do the biometric fingerprinting, and that's how Somalia is slowly now getting out of its rut that they've been put in because of the closed banking regulations. How many people have been affected by banking as far as regulation is concerned? Had the bank closed down? Or as a bank you may have closed down or regulated?
Questions actually. I didn't get the question.
Have you been affected by regulation by having your bank account closed down? Or if you are a bank like this, have you closed down accounts?
Yes, in certain cases, but depending on more blacklisting, more FAC, rather than regulation itself. At certain times, very, very selective regulation, but not specifically sent out. But there has been cases, obviously, when there are reasons beyond the regulatory framework. So yes, and more.
So is it mostly domestic oversight that is causing you to close, or foreign? I mean, is the U.S. Department of Treasury saying, hey, close this account down?
I would say it is foreign more. Domestic oversight is limited, but yes, foreign more. But that is, I think domestic is driven by partly with the foreign as well. It's interlinked in one way or the other. So there are locally maintained databases, lists, whatever, which are monitored, and there are obviously external as well.
Do countries open, for example, in Africa or in Europe, or do you guys open your money laundering lists to the outside world? Do you open your grey list and black list to the outside world?
We do get the sanctions.
Sanctions, but every country maintains its own certain list.
It's applied to both
Once a
sides.
license, yes. License.
So, how do we get regulation to be more streamlined? What do you think is the proposed method, in your opinion? Lazarus, let's have your opinion.
So I have a, anecdote. In Zimbabwe, you can walk out of the country with $3,000. Nobody asks you a question, right? So you can tell them, I've got $3,000. Okay, right, done. In and out. Why don't we align these regulations for mobile remittances with that, just as a starting point? Because people are sending $50, they must prove who they are, where they live. Sending $50 when they can take 10 times that amount almost out and inside the country without anybody asking them a single question. So there's a bit of a disjoint between movement of cash in my pocket across borders and movement of cash on a regulated system. If that were to be just that, if that were just to be allowed, make life a lot easier.
Dilip Ratha, who's the gentleman we all should know or would know if you're in the remittance space, he's the head of knowledge thing, but basically he has the World Bank remittance data. So all the data that, the numbers that we so quote, 600 billion, it comes from his department. And he's done an extensive study, 20 years, right? So 20 years of study, he says we do not have a single instance, right? Not a single instance where we can point a finger and say, because of remittances, money has now gone for money laundering purposes or for terrorist financing. There is no data to suggest so. And yet we are one of the most regulated industries in the world. Isn't that an oxymoron?
It is definitely. Kenya shut down all remittance licenses after the last attack they had while they investigated how the money came into the country. There is still no evidence that money came in through remittance channels. There are, we talk about the 600 billion number.
Which no one has seen by
No one, the unofficial, the informal remittance numbers can be twice, 3 times that. We don't know. We have no idea of those. Those channels are the ones that move money in and out. It's very unlikely that criminals will use micro remittance services, small
to
value
structure something like that
transactions
would require such an effort. Hugo, you want to say something?
Well, I just want to mention that
people who don't know, that's Superman of remittances.
Not at
If
all.
you don't know him, you're not in the remittance industry.
Thank you very much, but it's not true, you know. We do that all the time. I say the same thing about him. It's a mutual understanding. Now, I want to say something. I'll talk next, but I want to mention something. It's important to understand that the regulator is really the messenger. And when you say don't shoot the messenger, it's true. Regulations come because of politics. It's the politicians really who influence regulation. And who influences politicians? The market players. So there's a lot of things that happen in regulation that you have to step and see who is pressuring that regulation to be like that or that. I have talked to so many regulators in the United States that supposedly say this and that, and some of them are very aligned to the business side, understand it, know the low risk, etc. They just can't do much because there are pressures that they are submitted to, you know. So it's in every country. I always tell people, look at who's pressuring. Why is it happening? There's always political reasons, socioeconomic reasons. There's things that are happening behind closed doors that are influencing how regulation happens, you know, and that influences how the industry is perceived. I mean, the remittance industry has never really had, as an industry, a strong association that can vouch for the industry. It's always, I mean, it's a very young industry in a way, you know. And yes, they're big players, but there's so many ethnic players, you know. Every country is, and you know, it's a service to low-income people. So just, of course, there's NGOs that vouch for us. There is Dilip Ratha who fights for the industry, but basically, you know, we have the regulation that we're being inherited, that we're fighting for, but there's so many things around it that are pushing the regulation to be like it is. And it's not the regulator that really shapes the regulation. It's the outside forces. That's what I think it's important to perceive, you know.
You know, I'll say one thing, which is sometimes, if you look at the US, you cited an example, it's very interesting that US has something called the Operation Choke Point, which you all must be aware of. And amongst other things, money transmitters are included in that list, and they lose access to banking. And if you apply for a money transmitter license for any one of the 50 regulators, 47 to be exact, you need a bank account in order to open, in order for your license application to be considered. The very minute you walk into a bank and you say, I'm an MSB, a money services business, you won't get a license. You won't get a bank account, period. Unless you're very well connected or you're doing purely B2B, not doing P2P. And at the same time, the federal regulator, FinCEN, has a circular out saying that if this is an MSB business, you have to give them an account. And herein lies the challenge. It's a circle, you know, like running around a tree trying to chase your own tail, and you won't get a license. And even if you have a license, you won't get a bank account. You won't get a license because you don't have a bank account. And if you somehow did manage to get a license and a bank account, guess what? 30 days later, you get a notice and they'll yank it off you. So the problem, I don't know, still remains.
And just to follow your point, I was telling a couple people in the break, there's a Spanish lawyer who has challenged in court every single Spanish bank and have won every single case on closing of bank accounts.
In Europe?
In Spain. In Spain, the courts, I mean, every time a bank is going to close an account of a money transmitter, they called him, and he goes into the court and challenges the bank because of unfair competition, unlawful competition. It's the only place, really, because there's provisions in the law where he has been able to use these provisions for the court to say, you cannot, show me, give me reasons why you're closing that account. And he's won every single one of them. It's very interesting. I think he's 12, every single one. The banks even have done it twice, 3 or 4 years later, with the same company and still have lost. And it's the only case that I know, and I wish I can get more cases in other places, and there are lawyers thinking about it. But this is how, this is happening. It's the courts who are deciding. I don't think that a lawyer would have won 10 years ago a case like that. Why? Because the banks would never, nobody would challenge a bank. Things have changed because of the financial crisis, et cetera, et cetera.
Remittances are now a threat, high-risk business, and they call it, we are de-risking you from the banking world. So my question is, what happened in 2005 and 6 and 7 and 2002, and we were still there? It wasn't a de-risk, it was an issue then. Like I said, no significant data to suggest anti-money laundering, or terrorist financing. No significant data. Case here and there. If you actually go up, the US is a beautiful country because it puts all its court cases online. If you would actually search, if you go read the Q10 quarterly statements by MoneyGram and Western Union and so forth, you actually have to list by law all the cases against them. And all the cases against them are rogue banks or rogue money transfer. There's a Vietnamese couple doing $64 million in transactions a month that operates a dry cleaners business in Los Angeles. Where were the flags? That's $64 million. So it's not the remittance per se. It's people who are bad in that business who do that. And it's part of now, I believe, $120 million lawsuit with Western Union because Western Union yanked them. Same thing with MoneyGram, same thing with RIA.
Every single money laundering case has been with banks, the large ones, right?
Yeah.
HSBC, Barclays, all of them. They don't get sanctioned. They don't lose their licenses.
The Barclays has paid a fine again.
There's the cost of doing this.
If you haven't kept track of it, the third fine this year. And 130. Now it was, I think, 70 million pounds. Just the last one, because one FX trader decided. The willful default by banks in such cases where the alarm bells should have gone off and everything should have been flagged was just like suppressed. But there was no reason to blame a money services business or a remittance company or an MTO for that. I just don't see that. One area that is constantly being touted, and it's almost become a cliche, is interoperability. We will discuss interoperability, I think, tomorrow and the day after, and beat it to death and bring it back next year. Why aren't regulators moving towards that? Lazarus, you want to give us interoperability of payments, true payments, being able, I can send an SMS anywhere in the world today, can't do that with money.
Look, I think it's, given what we've just said about regulation currently, it's being rather optimistic to ask why aren't they there? And that's not to knock the regulators. Like I said, all respect must be given to the regulators because their biggest job is to manage risk. It's not really to manage opportunities. That's our job, and then to convince them of the opportunity. But my experience with regulators is that, first of all, they want to license you, the entity. That's their job. Then secondly, we are now saying, guys, can you help us to get together and get a standard amongst ourselves in the country first? That's mobile players in the same country. And then we're now saying also, can you help us get together as players so we can send money to each other across borders? I think it's not going to be a regulator's play that will drive that. It's going to be the industry that must get together, establish standards, using an independent player. I think the Visa guy was saying at Africa, use an independent player. In a World Bank, IMF type of setup, we get together, or Bill and Melinda Gates Foundation setup, we get together, we establish standards, we establish the benefits, etc. And then, as a body, we then suggest this to regulators. I don't see regulators driving interoperability in as much as it will help take up of the services, of the very tech services. But they won't, regulators won't do that at all. That's my take.
I differ a little on that. We have talked to regulators where they're quite interested in interoperability, in domestic interoperability. International is something that we're not looking at. So let's look at what drives interoperability.
First of all, do you know of any country that is 100% interoperable for mobile?
100%. They're still talking about it. They're still
Just
setting up things.
200 territories and countries.
Not a single one, but it's happening. It'll happen this year, next year. We'll talk about it at the next conference. But regulators are asking us about domestic interoperability. But look at what drives us. Usually in every market where there's mobile money, there's one dominant player. That dominant player does not want interoperability. Right? So,
Not by choice, but by regulation.
well, they don't. They would lobby the regulator for not introducing interoperability. But the regulators realize now that interoperability is essential to grow the market. So there are cases. I think the regulator has to mandate interoperability for it to happen in key markets. And we're seeing it happening. We're seeing inquiries from regulators to do that. And the other thing is, yes, of course, it's possible to set up the best model to set up for a regulator would be independent switch model. But there is another model that's worth looking at. Just throw open interoperability. Let players come in and get licensed for interoperability and let them compete on the interoperability market. That's another option.
Do you have a point?
I should let you know I was at the Bill and Melinda Gates Foundation last week. They had a boot camp for the Level 1 project where they've defined principles for an independent switch, and they are trying to help regulators and governments come up with.
Yeah, that document is up also, the concept paper for the switch.
Yes. Yeah. So Gates is trying to help regulators.
Work with them on that as well.
Yeah.
Inputs in that area.
Yeah.
So Carl Meows from the IMF told us that they're working on something in Tanzania. But that's the IMF brokering with the telcos, and I think Tigo was championing that. That's what he told us. But he gave a very interesting example that the only interoperable banking system in the world that's fully interoperable is Visa and MasterCard. That's all industry driven. That's not by regulation. So maybe that is the only proven model we know.
But I mean, it's Visa and MasterCard are card schemes, so they're slightly different. But for a telco-led interoperable system, there are 200 countries now, exactly 220 if you put countries and territories, that have 100% integration for SMS services. 100%, not 99.9. 220 countries, we do not even have a single example of mobile interoperability for payments. And I've been hearing it for 5 years, by the way, bro. I mean, I hear it every year.
The GSM has been working on mobile money interoperability for a long time. On drafting specs and so on. But again, it's market interest, right? The dominant players don't want interoperability.